How did early corporate bonds fund major infrastructure projects? Imagine a time when railroads were the lifeblood of a growing nation, connecting cities and transforming economies. Early corporate bonds were essential in making this happen, especially during the 19th century Industrial Revolution. These bonds are essentially loans that companies take from investors, promising to pay back the borrowed amount with interest over time. This method allowed businesses to raise significant funds without giving away ownership, unlike selling shares. The first major use of corporate bonds for infrastructure came from railway companies. Constructing railroads required vast amounts of money for laying tracks, buying materials, and building stations. Most companies or governments could not afford these costs from their own resources or through bank loans. To solve this, railway companies issued long-term bonds to the public and institutional investors. By doing this, they effectively borrowed money to finance their ambitious projects. These bonds often had government support or guarantees, which made them more appealing to investors. This backing helped reduce the risk for those investing their money, even though infrastructure projects carried high costs and uncertainties. The structure of these bonds sometimes mirrored early build-operate-transfer schemes. In these arrangements, private companies would finance and manage infrastructure for a set time before handing it back to the government. As industrialization advanced, other industries like steel and automobiles also began issuing bonds. This allowed them to expand their factories and upgrade equipment, further driving infrastructure development and urban modernization. Municipal bonds became popular as well, funding public projects like roads, bridges, and utilities. Local governments often used their taxing power to support these bonds, making them a reliable source of funding. Early corporate bonds provided a flexible way to gather funds for large infrastructure projects. They pooled money from various investors, spreading the risk while aligning private business goals with public needs. This was a significant step in the evolution of financial markets and institutions, paving the way for modern bond markets and large-scale infrastructure financing.